and I said, let me go put this in real estate because I don't want my money in the stock market when the crash occurs, not if, when. So then, and it wasn't so much per se a crash, but if you look here, go to the other side of this mountain, you start seeing the decline, right? So you got November 4,600, and then by March you're down to 4,300, and then by June you're down to 3,600 in the S&P. Now, and then you have some periods, a pretty somewhat flat region, and then you start seeing a little bit of an upward trend again. So now what you're seeing here, if you look at this section here, this is 2000, going back to October 2023. If you start here and you work up here, I want you to notice how this region here looks similar to this region here. The only difference is that this region lasted a lot longer. And the reason that this region, in my view, lasted a lot longer is because you had absolutely ridiculously insane Fed monetary policy. Around this time, the Federal Reserve, because everyone thought the pandemic was going to cause a prolonged stock market crash and a prolonged recession, they were pumping so much money into the economy that it was insane. I could not believe what they were doing because the whole time, people like Muhammad El Arian and others, Lawrence Summers, economists I respect, were saying, if you keep doing this, you are going to have a horrible inflation problem. You are going to balloon the national debt to a level that is unsustainable. What are you doing? And they kept doing it and doing it. I had no idea why, but what that does is that will pump up, that will cause what you call asset inflation. So you think regular inflation was bad, asset inflation is like double that sometimes. So basically, you pushed up the prices of real assets when you're pumping money into the economy. You pushed up the price of stocks. You pushed up the price of real estate. Everything went up. So what do we have now in the economy today? Well, we have an economy where 4 years after the pandemic, the cost of a home is about 40% higher than it was in 2020. Is anybody else concerned about this, or is it just me? This is crazy. This is not supposed to happen. National debt. If I show you the national debt clock, I have a little app that shows me the national debt on this app. It's debtclock.org or something like that, and it's an app. Let me see if I can find the app. Let me see. I'm trying to remember what the freaking app was called, but I have it on my phone and I can't find it, so I'm kind of mad right now. Give me one second. Let me see if I can find it. Oh man, I can't find the freaking app. I'm so angry at myself right now. But there's an app I have on my phone called that's a national debt app, and I don't know. I hate this. I'm so mad right now. Anyway, it keeps up with the debt, and I was going to read it off to you, and it's about 38 trillion dollars, which is an unbelievable amount of money. So as I read this article, I'm one of the experts that's very concerned. The problem with saying watch out is that you don't know when the other shoe is going to drop. I don't know if the correction is going to occur next week, if it's going to be next month, or if it's going to be next year. Nobody knows. Nobody knows when Cinderella's carriage is going to turn into a pumpkin. But I can tell you that it's going to definitely do that. I can tell you that right now, things that are happening in the market are not sustainable, and you really want to kind of be ready for that. That's my biggest takeaway from this. Whenever they take these surveys and they find out that everybody's feeling really bullish, what happens is that you create a market that trades on momentum, and it becomes very speculative. You see a lot of risk-seeking behavior, no different from the way teenagers with testosterone engage in risk-seeking activities, like they want to go and jump off a moving car just to impress a girl because teenagers are stupid, and that's what we did at that time. And so basically so effectively what the market does is the same thing. They just get sort of financially drunk and they're buying anything. They're pushing the prices of assets up to unsustainable, illogical levels, and the crash inevitably occurs because you also create a very fragile state where the minute anything crazy happens, the mark everybody's going to run. It's going to be a massive herd. The investors tend to invest in herds. One of my dissertation committee members, David Hirschleifer, who's a very wonderful guy. This is why I can't sit around and just be mad at all white people, because some of y'all try your best to be nice. And David Hirschleifer was just one of the nicest guys I ever met, and he helped me. He was responsible for helping me get my PhD. He's one of the best economists on the planet. He went to the University of Chicago, which is kind of the Vatican of finance, and he used to write a lot of papers about herding effects, and I would read his papers, and it taught me about how investors move. They move in packs like animals. So what happens when you get a herd of buffalo or a herd of zebras or whatever in one area, because they all come there because they think that there's food or something, whatever it is. And then what happens if you shoot off a shotgun? Well, then you're going to have a stampede. You understand? You get a stampede as soon as something triggers. So effectively, as soon as the economic shotgun goes off, and it's going to happen. Something, I don't know what it's going to be. They call these black swan events. So at some point, the shotgun's going to go off, the herd's going to stampede, and you're going to see blood all over the headlines. So a good way to prepare is to just do basic things to protect your portfolio: stop loss orders, put options, sell some off the top, diversification. There are a few little strategies you can use. I did a whole training for you guys on this, about 2.5 hour training. You can go to stormproofinvesting.com if you want a copy of that. That's stormproofinvesting.com. Do I think that it's time to buy? Here's another part of this that's going to sound a little bit hypocritical. I don't believe in necessarily shifting your strategy too much based on what you think is going to happen, because these things are really hard to predict. So, one example is that there was a guy who he absolutely positively freaking knew that the Chinese government was lying about its real estate market. He knew this back in 2014, because what happened was you had companies like Evergrande that were growing to valuations in the hundreds of billions, and they were building all this property and taking on all this debt to build all these apartment complexes. And he said, I don't believe that they're selling all these units. I don't believe that there are people moving in.